Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance to uncover the truth of what's really going on behind the official statements. And let me tell you, our company today has some interesting numbers to unpack that might just make you rethink your investment strategy if you haven't already. Today we're diving into a filing from Invesco Commercial Real Estate Finance Trust Inc., a company involved in the world of commercial real estate loans and securities. Essentially, they are investing people's money into real estate debt and related assets. It's a big business, and in this report they're giving us an update on their net asset value, or NAV, which is like a snapshot of what their entire pool of investments is worth at a particular moment. The date here is July 31, 2025, and the report is mainly about the value of their assets and what they owe. Think of it like this: if you owned a bunch of apartment buildings and office spaces, the NAV would be the total value of all those properties minus any mortgages or loans you owe on them. That's exactly what Invesco CREF is showing us here. They are telling us what their investment portfolio is estimated to be worth and how it's broken down. Let's get straight into the numbers, because that's where the real story is often hidden. The biggest chunk of what they own is their commercial real estate loan investments. As of July 31, 2025, this massive category was valued at a little over $3.6 billion. That's a huge amount of money tied up in loans secured by actual properties. They also have about 10.8 million in real estate related securities and a healthy chunk of 121.5 million in cash and cash equivalents, which is good to see a company having ready access to funds. They also report restricted cash and interest receivable, showing money that is owed to them or set aside. Added to this are derivative assets and other assets. Now here's where things get a bit more complex, and we need to be careful about how we interpret these liabilities. They have secured financing facilities, which sounds fancy, but essentially means they've borrowed money using some of their assets as collateral. This amounts to nearly $2 billion. Then there are collateralized loan obligations, which are basically packages of loans bundled together and sold to investors. Invesco CREF owes $1 billion related to these. They also note a revolving credit facility, which is like a flexible loan line that was not in use at this time. On the other side of those borrowings, they have interest payable on those loans and derivative liabilities. They also owe money for subscriptions received in advance, meaning customers have paid for future investments. Due to affiliates and management and performance fees, highlight payments owed to related companies or the management team, which is standard but always worth noting. Finally, there are accounts payable, accrued expenses and other liabilities, and importantly, common stock dividends payable, signaling money owed to their shareholders. When you put all of this together, the net asset value, or NAV, for the entire company as of July 31, 2025 is approximately $884 million. That's the net worth of all their investments after accounting for all their debts and obligations. But this NAV isn't just one big number, it's broken down by share class. Different types of investors get different classes of stock, and each class has its own NAV per share. For instance, Class S shares have a net asset value of $34.3 million, and that translates to about $24.98 per share. Then you have Class S1 shares. There's a much larger portion of the company's value tied up here at $378.4 million, resulting in an NAV per share of about $25.08. Class D shares are valued at $31 million with an NAV per share of $24.96. Class A shares are a significant part of the portfolio with a net asset value of $100 and NAV per share of $25.04. Class E shares represent $38.9 million in NAV with a share price of $25.60 per share. And Class F shares, the largest by total NAV in this breakdown, are valued at $221.3 million with an NAV per share of $25.77. It's interesting to see these slight variations in per share across the different classes. These differences are usually due to varying fees or distribution arrangements specific to each class of shares. The table also shows the number of shares outstanding for each class. So for Class F, for example, there are over 8.5 million shares outstanding, which when divided into the total ME for that class gives you that $25.77 ME per share. This is how they calculate what each individual share is worth after all the company's assets and liabilities are considered. It's important to remember that these NAV per share is what the company uses as its transaction price. This means that when investors buy or sell shares of this company, the price is directly tied to this calculated NAV per share as of the particular date. They mentioned that transactions on September 1, 2025 will use the NAV as of July 31, 2025. We'll use the NAV as of July 31, 2025. We'll use the NAV as of July 31, 2025. Now, here's a critical statement that investors need to pay close attention to. The company explicitly states that they include no discounts to their NAV for the illiquid nature of their shares. This means they are not reducing the NAV to account for the fact that it might be difficult for shareholders to sell their shares easily or quickly, especially when considering limitations on their share repurchase plan, which they can suspend or terminate any time. They also note that their NRV generally doesn't consider exit costs like selling commissions that would likely be incurred if assets were liquidated. This is a crucial disclaimer. The company is not guaranteeing that a shareholder will actually be able to sell their shares at this NAV per share price. They also cautioned that upon liquidation of assets or a sale of the company, the distributions per share might not equal the NAV per share. And importantly, they state that their shares are not expected to trade at their NAV per share on a national securities exchange. They are essentially saying that the NAV is an internal calculation for valuation purposes and doesn't reflect what you might get if you tried to sell your shares on the open market or if the company were to be dissolved. Let's look a bit deeper into how they value those commercial real estate loans. They use a discounted cash flow method, which means they project all the future payments expected from these loans and then discount them back to today's value using a specific rate. The key unobservable input here is the discount rate. As of July 31, 2025, the weighted average discount rate was 6.82%, with a range from 4.25% to almost 12%. This discount rate is really important because small changes in it can significantly impact the reported value of the loans. The report clarifies that this rate can change based on economic conditions, property valuations, and the specific details of each loan. Similarly, for their secured financing facilities, they also use a discounted cash flow approach. The weighted average discount rate here is 5.78%, with a much tighter range from 2.25% to 6.59%. Again, this rate is sensitive to market conditions and the health of the underlying real estate loans that serve as collateral for these facilities. These discount rates are not just abstract numbers, they directly influence the reported fair value of the company's assets and its overall NAV. To give you a quick portfolio update as of July 31, 2025, the company's commercial real estate loan portfolio had a fair value of $3.7 billion, which matched its outstanding principal balance. This suggests that the loans were valued at their face value at that time. During July, they also closed on 3 new loan originations. These included a $6.8 million loan for a self-storage property in Tacoma, Washington, a substantial $80.2 million loan for a 9-building industrial portfolio in Orlando, Florida, and a $50.6 million loan for an industrial property in northern Italy. These new deals show the company is actively deploying capital and expanding its portfolio in different real estate sectors and geographies. Now let's put on our Warren Buffett hat and analyze what this all means. The fact that Invesco CREF is so transparent about its NAV calculation and the various classes of shares is a good sign of operational clarity. They are upfront about the fact that their NAV is not a guarantee of liquidity, which is a responsible disclosure. The discount rates used in their valuation models for both loans and financing facilities are critical sensitivity points. If market interest rates rise significantly, or if the quality of the underlying real estate loans deteriorates, these discount rates could increase, pushing down the reported fair value of their assets and consequently their NAV. The company is heavily reliant on commercial real estate, which is an industry known for its cycles, while they are diversifying across property types like industrial and self-storage and geographies like the US and Europe. The core risk remains tied to the health of the commercial real estate market. Their use of leverage, particularly through secured financing facilities and collateralized loan obligations, amplifies both potential gains and potential losses. Looking at the numbers, the company has significant assets but also significant liabilities. The NAV itself of $84 million on total assets that are much higher before deducting liabilities shows that their financing structure is quite leveraged. Whether this leverage is appropriate depends on the stability and expected returns of their loan portfolio. Given the stated disconnect between NAV and market price or liquidity, they are essentially telling investors to be cautious about expecting to cash out at the NAV value easily. A key area to watch would be the trend in their discount rates and the performance of their underlying commercial real estate loans. Any increase in loan delinquencies or defaults would directly impact the cash flows used in their valuation models and could lead to a reduction in MIV models and could lead to a reduction in NIV. Also, changes in macroeconomic factors like interest rates, inflation, and economic growth will undoubtedly influence the value of their real estate assets and the cost of their financing. In conclusion, Invesco Commercial Real Estate Finance Trust is operating in a dynamic and often volatile sector. They provide a clear view of their portfolio's valuation through their NAV calculations, but they are also careful to temper expectations regarding the liquidity and saleability of their shares. Investors need to do their own due diligence, not just on the NAV, but on the underlying quality of the real estate loans and the company's ability to manage its debt effectively. In varying economic conditions. Alright, that's our breakdown of the Invesco CREF's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.